Now, I know I don't need to tell you that the vibes of the economy are a little bit weird right now. We have all felt the direct effects of rising prices, with literally everything costing more today than it did a year ago, and some of our household expenditures absolutely exploding over the last few months, sucking up any and all spare change we used to have. Inflation is sky high, the Federal Reserve is hiking interest rates, which makes our debt more expensive. The US was also officially in a recession for 6 months with negative GDP growth for 2 consecutive quarters, and yet unemployment is still very low, and there are still to this day more job openings in America than there are unemployed people. The very strange nature of this market turmoil means that many people are underestimating what's actually going to come next, but that would be a tragic mistake to make. So today, we're going to explain exactly what is going on, and in particular, we're going to explain why it's so important that you have cash saved up for what's coming next. So what exactly is going to happen over the next few years? Well, this will come as no surprise at all, but we are of course on track for a massive recession. Now, I would say that this is some kind of once-in-a-lifetime recession that we're going to see, but the reality is that the one we saw in 2008 was probably of a similar size to what we're about to see next, and it seems that in general, recessions are just getting bigger each cycle at the moment, so it probably isn't once in a lifetime, but that doesn't mean it isn't going to be massive. We will see productivity and economic activity across the entire world decline, probably for about a year-long period on the minimum end of things, and the consequences or the feeling of a recession will extend for a couple of years longer than that again at the minimum. Again, if we liken what's about to happen here today with what happened in 2008, our economies were only actually shrinking for a few quarters, but the impacts of that recession went on for years, with the job markets being very heavily damaged and people's incomes really not recovering until around about the 2012 mark on average. This failing economic activity will have immediate and visual effects on things around you that make up your life, but in reality, the failing economy is more of a symptom of what's going on rather than the causes itself. What will really be going on behind the scenes is really just more of what's already been happening over 2022 so far. We have seen inflation shoot up to extremely high levels, nearing 10% in the United States and actually far exceeding that level in a lot of places in Europe, and this is doing two things right away. Firstly, it's just making people poorer because the vast majority of people have not seen their income rise by 10%. So in proportion to what they can actually afford, the vast majority of people are today poorer than they were a year or 2 years ago. This, of course, has a direct impact on businesses and their profits, as consumers will simply put be less able to buy the stuff that they used to buy because their cash is now all tied up in housing costs, in insurance, and basic necessities like food. Those businesses that are then missing out on that consumer income make less money, which is something we've just started to see with this most recent earnings reports from American companies. And so these companies go out and they reduce salaries for their employees, they fire some of their staff, and they invest less into the future of their own business, into their own growth, which then ripples around the rest of the economy and impacts everything again. The other major thing that inflation does is it scares the government, and in particular, it scares central banks. It scares them for the reasons that we just explained, because it does actually fundamentally damage the economy itself, and so central banks in particular act to try and fight that inflation. This is what we've already seen over 2022, with most central banks raising interest rates to try and slow economic activity down, to bring inflation back down under control, and to bring stability back to our pricing mechanisms. The Fed in particular is now doing this in such a strong way that most investors think actually the balance has been entirely tipped into the other direction, that inflation won't actually be a problem in a year's time or so thanks to the Fed's action, but that the inflation problem will just be replaced by a recession problem caused by the Fed fighting that inflation. Now, whether or not this is actually true or likely to come true is sort of a video all on its own, but for the purposes of today, for this video right here, there is actually quite a strong chance that this is the case, and the evidence is starting to lean in that direction. So we have two major aspects that are causing inflation. So we have two major aspects that are causing a recession right now as we speak. We have inflation damaging consumers, and then we have the Fed sparking a recession to try and fight inflation. Of course, this is without even starting to mention all of the other things going on in the world, with the COVID lockdowns and the housing market crash in China, in Russia and Ukraine with the war between those two states, and with the energy crisis that is bringing Europe to its knees as well. In short, a recession that is absolutely massive is without a doubt on its way. There's just no stopping it, and the only thing we can actually do about it is to make sure we are as prepared as possible. Now here though is where the silver lining of this video is. A recession fundamentally will mean cheaper asset prices, and this is across the entire board. This will be of no surprise to most of you watching, but stocks have been losing value for almost all of 2022, with the indexes down by as much as 30% or even more at times. Now, if you've been paying attention to the markets, you've probably seen how badly stocks are performing this year, and you might be thinking about diversifying your portfolio, or maybe you just want to hedge against inflation. Well, then you need to hear about this video's sponsor, Vaulted. Now, Vaulted is the best way for individual or even institutional investors to acquire physical gold, with a great website and mobile app that makes it easier than it's ever been. They store and insure their one-to-one allocated gold in the Royal Canadian Mint. It's all certified conflict-free, and you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings whenever or wherever you desire. Their prices are the best in the market because they store all of their gold at the manufacturer, and so they cut out all unnecessary middlemen. They don't charge any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. On top of all that, they even managed to put out a load of really interesting content keeping you updated on the world of gold. Now, if that sounds at all interesting to you, then I highly suggest you check Vaulted out. There's a link for you all down below in the comments and the description. Again, that's Vaulted in the link down below in the comments and description. Some of the biggest and most successful companies in America are losing 70 or 80% of their value this year alone, but this is par for the course for a recession though, and the markets are always, to at least some degree, correlated to the state of the economy. Of course, though, it isn't just stock prices that are falling. We're seeing the housing market start to tip into a decline and probably even a crash as well. As the Federal Reserve is raising interest rates, mortgage rates have been spiking too, and they've now topped 7% for the average buyer in the United States over recent months, over twice what they were a couple of years ago. This, very simply put, means that people cannot afford the same house today that they could afford last year, and as interest rates are continuing to rise, in a year's time, they will not be able to afford then what they can afford now. This will have an effect on housing prices across the entire country and even the entire world, because this same mechanism is going on in every Western economy. House prices will fall as there will be fewer buyers and there will be less buying demand and buying pressure for every housing market. Prices could actually fall by as much as 40 or even 50% in some places, and that, just like with stock prices, presents an opportunity to savvy investors. There are many investors out there who have made themselves billions of dollars by buying up assets, whether they be stocks and shares, entire companies, or real estate at times of economic hardship. We also see this on a much smaller scale than billionaires though as well. Graham Stephan, who you can see behind me here, is probably best known as the king of YouTube finance, but he actually got started off as a realtor in the early 2010s, back when house prices still hadn't recovered from the housing market crash years earlier, and he managed to buy up some investment homes for a fraction of their current market value. Now, you may say that, well, that's fine for him, but Graham was rich, so this isn't really relevant to me watching this today, but actually he wasn't rich back then. He was fresh out of school, he had only just started to work his first real adult job as a realtor, and he didn't have any kind of family wealth, and he hadn't even gone to college or anything like that. Despite all that though, just by the virtue of being in the right place at the right time, and of course a hell of a lot of making the right decisions, he was able to buy up homes for a fraction of their true value, and that alone has now made him today millions of dollars. Now, maybe you're watching this and thinking, well, that sounds great, but I really don't want to be a landlord. I'd rather just invest in something truly passive instead. And if that is you, well, then that's totally fine as well. There is nothing stopping you from benefiting from buying up asset prices in the stock market when they are low as well. As we all know, the indices are down a massive amount so far this year, with the Nasdaq falling down below 30% at times, and some really good blue chip companies like Google or Amazon down by 40% or even 50%. And as I've already explained, the state of the economy and the market environment that these companies are going to be operating in over the next couple of years is actually going to get worse, not better, which means it's incredibly likely that stock prices are going to continue to fall. Let's also not forget the fact that the Federal Reserve is still tightening the monetary environment. They are still reducing the size of their balance sheet, taking liquidity away from the markets, and they're still increasing interest rates every single month. They've basically come out and said that in particular, they want to nuke the employment market, because until that happens, they can't be sure that inflation is actually going to fall. So we are going to see unemployment rise and consumer spending tank with that. The simple fact is that no asset class at all will be entirely immune from the effects of this, and so we are going to see prices stay low or even go lower. Now, I'm sure you can probably tell where I'm going with this video. I'm saying that we have a massive opportunity over the next year or so to invest at rock bottom prices and see our investments massively increase in value over the years that actually follow this recession. But this idea does require you to do one thing that's very difficult to wrap your head around at a time like this, especially with inflation being so high. As the title of this video suggests, to truly capitalize on this opportunity, you need to start saving cash, because without cash, you will not be able to buy at these rock bottom prices. Now, I know what some people will say to that. They'll say, well, why would I save cash when I can just use debt to buy at the bottom? And the problem with that line of thinking is that it's going to get harder and harder to actually acquire and get a hold of this debt as we move forward. When everyone is failing to pay off their credit cards, their HELOC loans, their car loans, and their mortgages, banks are going to be far more stringent when it actually comes out to handing out debt. And this will make it very difficult for you to actually capitalize on these super low prices. Again, some of you may say, well, if the markets are going to struggle for a couple of years, why would I save cash now when I can just do that later and not eat the hit from inflation? And the answer to that question is that you might actually not be able to do this later. When the recession kicks in, there's a decent chance that you have to take a pay cut or even lose your job altogether, or maybe your partner sees something similar to that happen, or maybe just your industry seriously suffers and you have to start your entire corporate career all over again in a new sector with a new company from the bottom up. The idea that you will just without a doubt be able to save cash to capitalize on this opportunity in the future is not at all guaranteed, and this is evidenced by what's happened in the past. Back in 2008, there were millions of people who knew that it was the perfect time to be investing in everything they could into the stock market, but they simply couldn't afford to invest because the economy was in the toilet, so every penny they had to just go on surviving. There were so many people who would have loved to buy up homes when they were at rock bottom prices, but 0% down mortgages had been done away with and they didn't have the cash that they needed for those down payments. If you actually want to make this recession work for you, to be one of the people who comes out of this crash better off instead of worse off, then you need to start now. Now, there is actually one other major reason why you really should be saving at least some of your cash, and it really isn't about making millions during a market crash. It's just the simple fact that you might get unlucky this time around, your company might go out of business altogether, and every other company in the same industry might seriously struggle too, and having cash to keep you going during those times is going to be seriously valuable. We all look back at the stock charts during 2008 or the 2000.com crash and think, how could anyone be so stupid that they sold all of their investments when the line was going down, knowing full well that if they just held on until some point in the future, the line would be going back up again. Now, of course, there were some people who just got it perfectly wrong and they sold at the bottom only to invest back on in later when the markets had recovered and they lost all of their gains. The problem is, though, the vast majority of people who sold their investments during the recession that followed the housing market crash, they did it out of necessity. They needed that money to pay their bills, to keep a roof over their heads, to keep food in their bellies, and to keep their kids in school, and they couldn't just push through until the markets had recovered. This time around, there will be many people just like that who have every penny invested in the markets, 100% sure that at some point in the future, those assets will be worth far more. But then when tragedy strikes and everything falls apart, some of these people will be forced to sell at the bottom just to keep their lives from falling apart, and having cash reserves that you've built up in advance can help stop this nightmare from actually coming true. It's a simple fact, you really should be saving cash at this sort of time in this market crash. And until next time, stay stoic.